Okay, let's unpack this. Imagine you're a partner in a bustling business, and you do something for the partnership. Maybe you provide some specialized services, or you sell a piece of property.
Right.
On the surface, that sounds pretty straightforward, doesn't it? But in the fascinating, often intricate world of U.S. tax law, the line between a partner acting as an owner and a partner acting like, you know, any other outside vendor or client can get surprisingly, almost deceptively blurry.
It really can.
Understanding exactly where that line is drawn can make all the difference when it comes to your tax bill.
Absolutely.
Today, we're taking a deep dive into that very distinction, exploring 26 U.S. Code Section 707. This section is a cornerstone of partnership taxation, meticulously designed to clarify when a partner truly acts like a partner and when, for tax purposes, they're treated as someone else entirely. And for those less familiar, when we talk about realized and recognized gains or losses, realized means a gain or loss has occurred on paper, right? An economic event has happened. But recognized means it's actually taxable or deductible right now. And Section 707 is often all about when the IRS decides to flip that recognition switch, potentially turning what you thought was maybe a deferral into immediate taxation.
Exactly. And what's truly fascinating here, and maybe the critical insight for anyone navigating partnership tax, is how Section 707 functions as this powerful anti-abuse provision.
Okay, anti-abuse.
Yeah. Its primary mission is to prevent partners from using their dual hats, as both an owner and a transacting party to manipulate tax outcomes.
Right.
It does this by often recharacterizing certain transactions to reflect their true economic substance rather than just their formal structure. So our mission today is to extract the most crucial insights from this complex code, helping you understand precisely how services, property transfers, and specific types of payments are treated.
And we'll look at control, too.
Oh, yeah. We'll pay particular attention to situations where a partner's control over the partnership becomes a significant factor, and why mastering these distinctions is absolutely vital for your tax planning. It's about making sure the tax implications align with reality, not just, appearances.
Got it. And our primary source for this deep dive is the legal text itself. 26 U.S. Code Section 707, explicitly titled Transactions Between Partner and Partnership. We'll be looking at how the IRS views these interactions, from disallowing losses sometimes to recharacterizing gains, and how it differentiates regular distributions of partnership profits from this unique beast called guaranteed payments.
Yeah, those are special.
It's all about how the law ensures fair play and prevents individuals from using the flexible partnership structure to get tax outcomes that wouldn't be available to unrelated parties, or that might seem like an unfair advantage.
It's like the IRS puts on its detective hat.
Yeah. Looking beyond the initial story to find the real plot. And that can profoundly impact your financial results, your actual tax-recognized gain or loss, and the partnership's basis in assets.
Yeah.
So let's kick things off with the fundamental rule, the bedrock of Section 707A1. This is all about what happens when a partner engages in a transaction with a partnership other than in their capacity as a member of that partnership.
Right. That phrase, other than in their capacity as a member, is key.
So the general principle here is straightforward, at least on the surface. If it looks like an arm's length transaction, meaning, a deal that would be made between unrelated parties bargaining freely, then for tax purposes, it's treated like one.
Exactly. It's considered as if it occurred between the partnership and someone who is not a partner.
That's a really important distinction, isn't it? Because your tax implications, how much gain or loss you recognize, can change dramatically depending on whether you're acting as an owner or like an external party.
Absolutely. And the why behind this rule is crucial because it goes right to the heart of preventing artificial tax advantages. Well, without this provision, partners could potentially use their dual role to achieve tax outcomes that would never be available to truly unrelated parties. Think about it. If a partner who also happens to own a separate business selling office supplies sells those supplies to their own partnership, should that deal be treated differently tax-wise than if the partnership just bought them from Staples?
Probably not, if it's a real sale.
Section 707(1) says, generally no. If that partner is acting purely like a vendor, negotiating a price, delivering goods, sending an invoice, just like any unrelated seller would, then for tax purposes, it's treated exactly like any other sale.
So, okay, if it's treated like a regular sale, what are the immediate tax implications? For the partner selling and for the partnership buying, how does that affect their recognized gain or loss and basis?
Right. Well, for the selling partner, they would immediately recognize any gain or loss on that transaction. It's a taxable event for them right then and there.
Okay, so no deferral.
No deferral. If they sold it for a profit, that realized profit becomes recognized taxable income. If they realized a loss on the sale, that loss could potentially be recognized as a deduction, depending on other rules we might get into later.
Got it. And for the partnership?
For the partnership buying the supplies, they would take a cost basis in those supplies, meaning their basis, the amount they can potentially deduct or use to calculate gain later, is the amount they paid for them.
Not like a contribution where they might get the partner's old basis.
Exactly. Not a carryover basis you often see in a typical capital contribution. It's a purchase price basis. And if those supplies are used in their business, they typically deduct the cost as an ordinary and necessary business expense, assuming it's not something they need to capitalize.
So this rule prevents a partner from trying to structure what is economically just a sale or maybe a payment for services as something else, like contributing property and then taking a distribution back, just to avoid or delay recognizing that gain immediately.
Precisely. The core insight here is that the tax code prioritizes economic reality over the legal form. Even if the person is a partner, if their actions in this specific transaction are those of an independent contractor or a vendor, the tax system says, okay, for this deal, you're a vendor.
That makes perfect sense. But if it's so straightforward, where do people typically get tripped up on this arm's length idea?
Yeah.
Are there common scenarios where it looks like an arm's length deal, but maybe the IRS disagrees?
Yeah, that's a great question, and it's where the nuance really comes in. One common area of confusion is definitely services.
Okay.
Imagine a partner who is also a licensed architect. The partnership needs a new office designed. If this partner, acting as an architect, designs the building and charges the partnership a fee that's comparable to what an unrelated firm would charge.
A market rate fee.
Right, a market rate fee. And they carry the typical risks of an independent contractor, like maybe liability for errors, then it's likely treated as a transaction with a non-partner under 707A1.
So the partner reports the fee as income, the partnership pays it, and maybe capitalizes it as part of the building cost.
Exactly. Partner recognizes income, partnership treats it as payment to an outsider. But the line blurs if the services are really integral to the partner's core role as a partner.
Like what?
Like if a partner's primary role is managing the partnership's properties and they perform routine management tasks, that's typically a partner acting in their capacity as a partner.
And their compensation wouldn't usually be treated under this rule.
Right. Their compensation would usually be structured as a distributive share of profits, or maybe a guaranteed payment, which we'll get to later under 707C. The IRS looks at factors like, does the partner bear significant entrepreneurial risk related to this specific payment? Is the payment tied to the overall success of the partnership? Is the partner really acting independently, or is this just part of their job as an owner?
So it's about the risk and the connection to the overall business success.
Largely, yes. The brilliance of this whole area, especially when we get into the next part, isn't just catching direct swaps, but how it forces taxpayers to prove the lack of relatedness between different steps, shifting the burden of proof in subtle but powerful ways.
So you can't just, delay a payment for 6 months and say it's unrelated.
Not necessarily. The IRS looks at intent and the overall economic effect, not just timing. They're looking for substance. It's kind of like the partnership saying, look, you're a great partner, but right now, for this specific deal, you're just another vendor. Here's your 1099, maybe. Not quite as warm and fuzzy, perhaps, but clearer for tax.
Okay, here's where it gets really interesting, maybe a bit more complex, where the IRS starts playing detective more actively. This subsection, 707A2A, dives into situations where a partner performs services for a partnership or transfers property to it. And then there's a related direct or indirect allocation of income and a distribution of cash or property back to that partner.
Right. The related part is crucial.
And if, when you look at the whole picture, these actions are properly characterized as a transaction with a non-partner, meaning it really looks like a payment for services or a sale of property, that's exactly how they'll be treated.
Yeah, the IRS is basically saying, nice try. We see what you're doing here, arranging contributions and distributions to look different, but we're going to tax the substance of your actions.
Okay, but this raises the big question. How do you determine if it's properly characterized as a non-partner transaction? What makes it related?
The code emphasizes the relatedness of the service or property transfer and the subsequent allocation and distribution. It's essentially a look-through rule that IRS isn't easily fooled by just calling something a contribution or distribution. They're looking at the substance over form.
So what are they looking for?
The goal here is to stop partners from structuring what should be a taxable payment for services or for property as a tax-free partnership distribution or a tax-deferred contribution. For instance, if a partner who's also a real estate developer contributes land to a partnership and very shortly after receives a large distribution that conveniently matches the fair market value of that land, and this distribution wasn't really tied to overall partnership profitability or risk,
Right.
the IRS might very well recharacterize that entire sequence. They'd say, that wasn't a contribution and distribution, that was a sale.
So the IRS is looking for that connection.
Yeah.
But how close does the connection have to be? Is there a specific timing rule or like red flags they look for to spot these disguised transactions?
That's a crucial point. While there isn't a hard and fast timing rule written right into the statute for this specific part, unlike the property sale part we'll discuss next, the regulations under Section 707A give guidance. For services and related allocations distributions, the key factors the IRS considers are things like, was the payment made pursuant to some kind of arrangement?
Like a contract.
Could be a contract, could be an understanding. And critically, does the partner bear significant entrepreneurial risk with respect to that payment?
Meaning, could they potentially not get paid if the business does badly?
Exactly. If the payment is fixed or determined by a formula that doesn't depend on partnership income, or if the partner's services are rendered expecting and depending on getting that related allocation and distribution, it starts to look much more like a non-partner transaction, like a fee for service.
Can you give an example?
Sure. Let's say a partner agrees to perform architectural services for a partnership for a fixed fee of $50,000. Soon after they finish the work, the partnership makes a special allocation of $50,000 of income to that partner and distributes $50,000 cash to them.
Okay.
The IRS would likely look at that and say, hold on, that fixed amount linked closely in time to the service, that's payment for services rendered in a non-partner capacity.
In the tax result.
The income would be taxable to the partner as ordinary income, likely subject to self-employment tax. And the partnership would treat the $50,000 as payment for services, either deducting it if it's an expense or capitalizing it if it relates to creating an asset, just as if they'd hired an outside architect.
So it avoids the partner treating it as maybe a tax-free distribution that just reduces their basis.
Correct. It ensures the income is recognized appropriately.
Okay, now what if it is recharacterized as a sale, like in your land example? What are the tax consequences then for the partner who contributed the property? And for the partnership, how does that affect their gain, loss, and basis calculations?
Right. If the sequence is recharacterized as a sale, the partner is treated as having sold the property to the partnership.
Okay.
This means they would recognize any realized gain or loss on that sale immediately in the year of the transaction.
So calculate the gain or loss. How?
The amount of gain or loss would be the difference between the fair market value of the property, which is usually deemed to be the amount of the related distribution they received, and their adjusted basis in that property.
So if a partner put in land with a basis of, say, $100,000, but it's worth $500,000, and they get a $500,000 distribution tied to it.
Boom. They'd recognize $400,000 gain right then. $500,000 proceeds minus $100,000 basis. That gain is taxable immediately.
Wow. Okay. And the partnership. What's their basis in the land now?
The partnership would treat the receipt of the property as a purchase. So their basis in the property would be its cost. Typically, it's fair market value at the time of the transfer, so $500,000 in that example.
Which is higher than the $100,000 carryover basis they would have gotten in a true contribution.
Exactly. A higher basis can be beneficial for the partnership down the road, maybe for future depreciation deductions if it was depreciable property, or for reducing their gain if they later sell the property.
So the partnership gets a step up in basis, but the partner pays the price with immediate gain recognition.
That's the trade-off triggered by the recharacterization. It's a really critical anti-abuse measure to make sure income is properly recognized at the right time and with the right character, preventing artificial deferral. The IRS is like that master detective, always looking past the label contribution to see if there's a hidden sale. They've seen a lot of variations.
Okay, this sounds like the mirror image of the last rule, and just as important for understanding property transfers. What if a partner transfers money or property to the partnership, and then the partnership transfers money or other property back to that partner, or maybe even to another partner? If those transfers, viewed together, are essentially sale or exchange,
Yeah.
the economic reality is a sale, then that's exactly what the IRS calls it, and that's how it gets taxed.
Yep, this section, 707A2B, is specifically designed to catch those indirect maneuvers that try to make a sale look like a tax-deferred contribution followed by a tax-free distribution.
A common tactic, you think?
Oh, historically, it was a significant area for planning, which is why this rule exists. The key elements are that the transfers must be related and properly characterized as a sale or exchange. And notice, it specifically mentions direct or indirect transfers.
So it's broad.
It's very broad. So if a partner transfers a valuable piece of land to a partnership, and shortly thereafter, the partnership distributes a large chunk of cash to the partner, maybe cash that was funded by a mortgage the partnership took out on that very land.
Ah. Okay, that sounds suspicious.
Right. It looks suspiciously like a sale of the property, or at least part of it, for the cash received from the loan proceeds. The statute is designed to look past the separate steps and view the transaction as a whole to find its true nature.
So what does related mean here? Is there a specific time frame the IRS uses to connect these dots?
Yes, unlike the previous section, the regulations here provide a very important timing guideline. Transfers between a partner and a partnership that happen within a 2-year period are presumed to be a sale or exchange.
Presumed, meaning the IRS assumes it's a sale unless proven otherwise.
Exactly. It's a rebuttable presumption. The taxpayer can present evidence to prove the transfers were not a sale, but the burden of proof is squarely on them to show that the distribution wasn't, in substance, payment for the property.
And if the transfers are more than 2 years apart?
Then they are presumed not to be a sale. But again, it's rebuttable. The IRS can still challenge it if the facts and circumstances strongly indicate it was actually a disguised sale, even outside the 2-year window.
Okay, so the 2-year window is a big deal. What other facts and circumstances does the IRS look at, besides timing?
The regulations list several factors. Some key ones include: 1. Legal enforceability. Was the distribution legally required? 2. Timing and amount certainty. Was the timing and amount of the second transfer, the distribution, reasonably certain when the first transfer, the contribution, happened? 3. Debt relationship. This is a big one. Was the distribution sourced from proceeds of a partnership borrowing? Was that borrowing anticipated when the property was contributed? Is the debt secured by the contributed property? Did the partner basically shift their own debt onto the partnership related to the property?
Okay, debt is a major red flag.
Huge red flag. Also. 4. Entrepreneurial risk. Was the partner's right to receive the distribution subject to the ups and downs, the entrepreneurial risks of the partnership's business? If the distribution was pretty much guaranteed regardless of profits, it looks a lot more like sale proceeds. 5. Partnership's need. Did the partnership actually need the property for its business? How quickly did they use it or get rid of it?
Let's use an example. Say a partner transfers highly appreciated land basis, $100K, value $1 million to a partnership.
Okay.
3 months later, the partnership takes out a non-recourse mortgage for $700,000 on that specific land and immediately distributes $700,000 of the loan money to the contributing partner.
That transaction happening within the 2-year window, with the distribution clearly tied to debts secured by the contributed property, that screams disguised sale under these rules, at least to the extent of the $700,000.
Wow. Okay. That really clarifies how the IRS connects the dots.
Yeah.
So if the IRS determines this is a disguised sale, what does that mean for the tax implications for both the partner and the partnership? How do they calculate the gain or loss now?
It means that instead of the partner potentially getting tax-deferred treatment on the contribution and the partnership getting a carryover basis, the transaction is treated as a sale, at least in part.
So for the partner?
For the partner, they would calculate their realized and recognized gain or loss. The gain is the difference between the amount treated as sales proceeds, the $700,000 distribution in our example, and the portion of their basis allocated to the park sold.
So if $700K out of $1 value is deemed sold, that's 70%. They use 70% of their $100K basis.
Precisely. They'd allocate $70,000 of their basis, 70% of $100 to the part sold. So the recognized gain would be $630,000. $700,000 precedes $70,000 basis, and that gain is taxable immediately.
Got it. And for the partnership, what's their basis in the land?
The partnership is treated as having purchased 70% of the property and received 30% as a contribution. So their basis would be a mix, a cost basis of $700,000 for the part deemed purchase, plus a carryover basis of $30,000, 30% of the partner's $100K basis for the part deemed contributed. Total basis, $730,000.
Which is, again, higher than the pure carryover basis of $100K they get without the disguised sale rule.
Right. It often results in a significantly higher basis for the partnership, which could be beneficial for them later, but the partner pays the tax up front on the gain.
And what if it's between partners, not directly involving the partnership in the distribution?
Yeah, these rules can also apply if the transaction is properly characterized as a sale between two or more partners acting outside their partnership capacity.
Like if I contribute property, you contribute cash, and the partnership immediately gives my cash to you.
Exactly. If it's clear that was just a roundabout way for me to sell the property to you using the partnership as a conduit, Section 707A2B could recharacterize it as a direct sale between us partners. The nuances get complex fast, highlighting why careful planning and understanding the substance is crucial.
Okay, so these rules define when a partner acts as an outsider, and how transactions that look like contributions distributions might be recast as sales, triggering immediate tax and affecting basis.
Hmm.
But what happens when partners do engage in transactions with their partnership and there's a significant control element? That's where things get even more specific, right?
Yeah.
And the rules get tougher.
That's right. Section 707B addresses transactions specifically within controlled partnerships, aiming to prevent very particular types of tax manipulation.
Okay, many business owners, especially in like family partnerships or closely held ones, might think they've found a clever way to generate a tax loss. They sell an asset that's gone down in value that they own personally to their own partnership.
Seems logical on the surface.
Yeah, it feels like a real transaction. But the tax code has seen this movie before, and Section 707B1 is its answer. So imagine you own, say, more than 50% of a partnership, and you sell property to it, realizing a loss. You might think, great, a tax deduction, but hold on.
Not so fast. Section 707B1 steps right in to disallow those losses.
Disallow them completely.
For recognition purposes by the seller at that time, yes. This isn't just a minor detail. It fundamentally changes your tax outcome. The loss is realized, an economic loss occurred, but it's not recognized as a deduction on your tax return at that point. And connecting this to the bigger picture, this rule is a critical anti-abuse provision. It's designed specifically to prevent the creation of artificial losses just for tax purposes.
How would that work without the rule?
Well, a partner could sell a depreciated asset, say stock that's dropped in value to their controlled partnership. They'd claim a deductible loss on their personal return. But the asset itself, it's still within their effective economic control, just held by the partnership they dominate.
So they get the tax break without really losing economic control of the asset.
Precisely. It goes against the principle of needing a true economic loss, often involving a change in control, to get a deduction. So the code blocks it in two main scenarios.
Okay, what are they?
1. A sale or exchange, directly or indirectly, between a partnership and a person who owns, directly or indirectly, more than 50% of the capital interest or the profits interest in that partnership.
So partner selling to their controlled partnership or the partnership selling to its controlling partner.
Correct.
Okay.
And 2, a sale or exchange between two partnerships in which the same persons own, directly or indirectly, more than 50% of the capital or profits interests in both partnerships.
So between two commonly controlled partnerships.
Exactly. Prevents shifting losses between related entities, too.
So to be crystal clear, the loss is realized economically, but it's not recognized for tax purposes by the seller at that moment. No deduction then. But you mentioned this doesn't apply to selling your actual interest in the partnership itself.
That's right. That's an important carve-out. Selling your partnership stake, your ownership interest, is treated differently. This rule is about losses on property sold between the partnership or related partnerships.
Okay. Is the loss just gone forever then?
Not necessarily. There's a potential relief provision referenced through Section 267D that applies to subsequent sales by the buyer.
Okay. How does that work?
If the partnership that bought the property, or the other controlled partnership, later sells that same property to an unrelated third party at a gain, the previously disallowed loss can be used to reduce or offset the gain realized on that subsequent sale.
So the recognition is just deferred potentially.
It's deferred and potentially usable against future gain on that specific asset. It ensures the loss isn't immediately deductible while economic control remains, but it's not totally vaporized if the property is eventually sold outside the controlled group and there's a gain to offset.
But it only offsets gain, right? It can't create a loss on the second sale.
Correct. It can only reduce a subsequent gain down to zero. It can't turn a small gain into a loss or increase a loss on that second sale. Any part of the disallowed loss that exceeds the subsequent gain is just lost at that point.
Can you give us a concrete example? Numbers always help.
Sure. Let's use the partner-to-partnership scenario. Suppose Maria owns 60% of Partnership Alpha. She has equipment with an adjusted basis of $10,000, but it's only worth $8,000 now.
Okay.
Maria sells the equipment to Partnership Alpha for $8,000. She realizes a loss of $2,000, 10K basis, $8K proceeds.
But because she owns over 50%.
Right. Under 707B1, that $2,000 loss is disallowed. Maria cannot deduct it on her personal tax return that year. Partnership Alpha takes the equipment with a cost basis of $8,000.
Okay. Now, what if Alpha sells it later?
Let's say a year later, Partnership Alpha sells that same equipment to a totally unrelated company for $9,000. Alpha realizes a gain of $1,000. $9,000 selling price, $8,000 basis.
Now the relief rule kicks in.
Yes. Maria's previously disallowed $2,000 loss can be used by Partnership Alpha to offset that $1,000 gain. So Alpha's recognized gain on that sale is reduced to zero.
And what happens to the other $1,000 of Maria's disallowed loss? $2,000 disallowed, $1,000 used.
That remaining $1,000 just disappears. It's gone. It can't be used for anything else.
Wow. Okay. And the partnership-to-partnership scenario?
Similar idea. Say Partnership Beta and Partnership Gamma are both 70% owned by John and Sarah. Beta sells an asset, basis $50 to Gamma for $40. Beta realizes a $10K loss.
Disallowed because they're commonly controlled, 50%.
Right. Gamma takes the asset with a $40K basis. If Gamma later sells it to an outsider for $45K, Gamma realizes a $5K gain, $40K.
And Beta's disallowed $10 loss can offset that.
Yes. Gamma uses $5 of Beta's disallowed loss to wipe out its $5K gain. Recognized gain is zero. The other $5 of Beta's original disallowed loss vanishes.
It's a very pointed rule then. Forces losses to be recognized only when there's true economic detachment.
Exactly.
Okay, that covers disallowed losses. But on the flip side, what about gains? Sometimes the issue isn't disallowing something, but changing its character for tax purposes.
Right. While some rules block losses, other rules prevent taxpayers from turning what should be ordinary income into more favorably taxed capital gains.
And 707B2 does this in the controlled partnership context.
Precisely. If you sell property to a controlled partnership or between two controlled partnerships, and that property in the hands of the buyer, the partnership receiving it, is not a capital asset.
Like, what kind of property would that be?
Think inventory or depreciable property used in the partnership's trade or business. Things that would generate ordinary income or deductions for the partnership through its operations or eventual sale.
Okay, so if you sell that type of property to your controlled partnership, even if it was maybe a capital asset to you, what happens to your gain?
Any gain you recognize on that sale is automatically treated as ordinary income, not capital gain.
Ouch, that could be a big tax rate difference.
It can be huge, and this raises the important question, why the recharacterization?
Yeah, why?
The goal here is to prevent tax arbitrage. Specifically, it stops a partner from selling property that will be ordinary income property in the hands of the partnership and reporting their gain on the sale as lower taxed capital gain.
So you can't just cleanse the character of the income by passing it through yourself first.
Basically, yes. It ensures the character of the income aligns with how the asset will actually be used in the controlled business. If the asset, once the partnership owns it, would produce ordinary income for them, then any gain on getting it into that partnership should also be ordinary income for the seller.
And this applies to the same two scenarios as the loss rule.
Yes. Sale between a partnership and a more than 50% owner, or a sale between two partnerships with more than 50% common ownership.
So this directly impacts the calculation of tax on the recognized gain, potentially bumping it from, say, a 15% or 20% capital gains rate up to maybe 37% ordinary income rate. That's significant.
Absolutely significant. The definition of property other than a capital asset refers back to Section 1221, so it includes inventory, property held primarily for sale to customers, depreciable business property, certain self-created intangibles, etc.
Can we have an example of this gain recharacterization?
Sure. Let's take David, who owns 70% of a construction partnership. David personally owns a piece of heavy excavating equipment. Maybe he held it for a while, used it lightly. To him, it might be a Section 1231 asset.
Meaning gain on sale would normally be capital gain, mostly?
Right, assuming no depreciation recapture issues. But now, David sells this equipment to his 70% owned construction partnership. The partnership is going to use it heavily in its construction business.
So in the partnership's hands, it's depreciable property, used in its trade or business.
Yeah.
Not a capital asset.
Exactly. So under Section 707(b)(2, any gain David recognizes on that sale, the difference between the selling price and his basis is recharacterized from potential capital 2231 gain into ordinary income.
Even if he never used it that way himself.
Even then, the test is the character of the asset in the hands of the transferee, the buyer.
Another example, maybe with land.
Good one. Say a partner holds undeveloped land purely for investment, a capital asset for them. They sell it to a controlled partnership whose business is developing land and selling lots to customers.
So the land becomes inventory for the partnership.
Right. In the partnership's hands, it's property held primarily for sale to customers in the ordinary course of business. Therefore, any gain the partner recognizes on the sale to the partnership gets recharacterized as ordinary income.
It prevents converting future ordinary income from land development into a current capital gain just by selling it to the controlled entity first.
That's the core purpose. It maintains tax fairness, prevents unintended benefits through these related party deals, ensuring the income character follows the asset's character in its ultimate business use within that controlled group.
Okay, we've thrown around this controlled partnership and more than 50% ownership threshold quite a bit for both the loss rule and the ordinary gain rule. But how do we actually figure out if a partnership is controlled? Is it just what I own directly?
No. It's definitely not just direct ownership. That would be too easy to get around.
I figure.
The law uses that specific threshold,
Mm.
more than 50% of either the capital interest or the profits interest. But here's where it gets really tricky and much broader. Something called constructive ownership.
Constructive ownership. Sounds complicated.
It can be, but it's absolutely crucial for understanding the true reach of these 707(b) rules. It's where many taxpayers get caught completely unaware.
So what does it mean?
The concept is that ownership isn't just about what's listed next to your name on the partnership agreement. The tax code casts a very wide net. It attributes ownership to you through various relationships, even if you don't directly hold the interest yourself.
So it pulls in ownership from related people or entities.
Exactly. For purposes of the loss disallowance, 707(b)(1, and the ordinary income rule, 707(b)(2, the ownership of a capital or profits interest is determined by applying the constructive ownership rules found in Section 267(c), but with one specific exclusion. We ignore paragraph 3 of 267(c) for this purpose.
Okay, skipping the technical bits of 267(c)(3, what does get included? What are the main ways ownership gets attributed to you?
Right. Let's break down the main types of attribution under 267(c) that apply here. The whole point is to stop people from just splitting ownership among relatives or related entities to duck under that 50% threshold.
Makes sense. So what's the first type? Family.
Yes, family attribution. This is often the most surprising one for people. You are considered to own not only the partnership interest you hold directly, but also any interest owned directly or indirectly by your spouse, your siblings, whole or half-blood, your ancestors, parents, grandparents, and your lineal descendants, children, grandchildren.
Wow, that's broad. Siblings, parents, kids, spouse.
It is. So for example, partner Sarah directly owns 40% of partnership Z. Her brother Mark owns another 20%.
Okay.
For testing control under 707(b), Sarah is considered to own 60%, her 40% direct plus Mark's 20% attributed. Boom, she's over the 50% threshold.
So any sale between Sarah and Partnership Z, or maybe between Partnership Z and another partnership Mark controls, could trigger these rules.
Potentially, yes, because she's deemed a controlling partner due to attribution from her brother.
Okay, what else besides family?
Attribution from entities. An interest owned by a partnership, corporation, estate, or trust can be attributed out to its owners or beneficiaries.
How does that work? Like, proportionally?
Yes. For partnerships, an interest owned by Partnership A is considered owned proportionally by its partners. So if Partnership A owns 60% of Partnership B and you own 30% of Partnership A,
then I'm deemed to own 30% of that 60%, which is 18%.
Exactly. You constructively own 18% of Partnership B through Partnership A. If you also owned, say, 35% of Partnership B directly, your total ownership for 707(b) purposes would be 53%, 35% direct plus 18% attributed. Again, over the threshold.
Okay, and corporations or trusts?
Similar idea. From corporations, if a corporation owns a partnership interest, it's attributed proportionately to its shareholders, but generally only if they own 50% or more of the corporation. From trusts, attributed proportionately to beneficiaries.
So if my family corporation owns 100% of Partnership Y, and I own 70% of the family corporation,
then you're considered to constructively own 70% of Partnership Y.
The point of all this is to make sure economic control is the real measure, not just legal title on one piece of paper.
That's it, exactly. It prevents individuals from easily skirting the 50% threshold just by spreading ownership among closely connected parties or entities they control.
This seems like a very common trap for people in family businesses or closely held groups.
It's one of the most frequent missteps, honestly. What looks like a transaction between separate people or entities can suddenly fall under the controlled partnership rules if you haven't meticulously traced all the direct and indirect ownership through these attribution rules.
So if I own 40% directly, and my spouse owns 20%, I'm treated as owning 60%. That triggers the rules for deals between me and the partnership. Critical detail.
Absolutely critical. It makes tax planning in these situations complex, but essential. You can't just move an asset to a different entity on paper if that entity is still fundamentally controlled by the same economic unit. The IRS looks at who really benefits and controls things. Ignoring attribution is asking for trouble, potentially leading to disallowed losses or recharacterized gains you didn't expect.
Okay, so we've covered transactions that look like sales, 707A, and these tough rules for controlled entities under 707B that disallow losses or recharacterize gains, which definitely impacts how realized and recognized gains and losses are treated and basis. But what about payments to partners that don't depend on the partnership's income? You mentioned those earlier. They have their own special category.
Yes, they do. Section 707C carves out a unique type of payment called guaranteed payments, and they have a very distinct tax treatment we need to understand.
All right, Section 707C. This is a really distinct type of payment in partnership tax, different from what we've discussed so far. Guaranteed payments. They're made to a partner either for services they perform for the partnership or for the use of capital they've provided. But here's the critical defining part. They are determined without regard to the income of the partnership.
That phrase is everything. Without regard to the income of the partnership, that's the absolute key differentiator.
Why is that so important? How does it separate them from other ways partners get money?
Well, what's fascinating here is precisely how this distinguishes them from a partner's typical distributive share of partnership income.
Yeah.
A partner's distributive share, their percentage of the profits or losses, is directly dependent on the partnership's income. If the partnership has a great year, their share goes up. Bad year, it goes down. Maybe it's even a loss they share.
Right, that makes sense, tied to performance.
Guaranteed payments, on the other hand, are different. They are fixed amounts, or maybe they're determined by a formula. But crucially, that formula doesn't fluctuate with the partnership's bottom line income or loss for the year.
So whether the partnership makes $1 million, breaks even, or loses money, the partner gets this specific payment amount.
Exactly. The guaranteed payment remains the same. This makes it feel much more like, say, an employee's salary or an interest payment on a loan from an unrelated bank, which is why the tax code, as we'll see, treats them similarly in some key ways.
Okay, an example would probably help make this distinction really clear.
Definitely. Let's imagine a small consulting firm with 3 partners, Alex, Ben, and Chloe.
Okay.
Guaranteed payment example. Alex is the managing partner and does a lot of the day-to-day running of the business. The partnership agreement says Alex receives a fixed salary of $150,000 per year for these management services. This payment is due to Alex regardless of how profitable the firm is that year. Even if the firm operates at a net loss, Alex still gets his $150,000.
So that $150,000 is a guaranteed payment.
Yes, because its determination is made without regard to the partnership's income. It's fixed.
Got it. And Ben and Chloe.
Distributive share example. Let's say Ben and Chloe are the primary consultants bringing in business. The agreement says after paying Alex's $150 guaranteed payment, Ben and Chloe each receive 50% of any remaining net profits.
So their share depends entirely on the profits.
Exactly. Their share is directly dependent on the partnership's income after the guaranteed payment. High profits, high share for them. Low profits, low share. That 50% of net profits for Ben and Chloe represents their distributive share of partnership income.
So the without regard to income clause is the absolute litmus test for 707C. It means the partner bears no entrepreneurial risk with respect to that specific payment, unlike their share of the residual profits or losses.
You nailed it. That lack of risk on the payment amount itself is key. And this predictability is often why partnerships use them, maybe to ensure partners providing essential services or partners who contributed significant capital receive a baseline, consistent payment irrespective of the business's yearly income swings.
Okay, so we know what they are. Now, how are they taxed? You mentioned they're treated differently. Even though they're paid to a partner, who we normally think of differently from an employee or a vendor, Guaranteed payments get treated as if they were made to someone who is not a partner, but only for two specific important purposes.
That's right. It's this dual character that makes them unique and really vital to understand for tax calculations.
So this raises the question, what are those two purposes, and why is this dual character so significant for figuring out the tax hit for both the partner getting the money and the partnership paying it?
Okay, the first purpose relates to the partner receiving the payment. For their income tax calculations, specifically under Section 61A gross income, the guaranteed payment is treated as ordinary income.
Just like a salary.
Pretty much. It's considered gross income, just like an employee's salary or an independent contractor's fee would be. It's not treated as a tax-free return of capital distribution or some special partnership distribution that just reduces their basis in their partnership interest.
So it's fully taxable ordinary income to them right away.
Fully taxable ordinary income reported on their personal return, and importantly, guaranteed payments made for services rendered are generally subject to self-employment tax for the receiving partner.
Ah, so they have to pay Social Security and Medicare taxes on it, just like an independent contractor would.
Generally, yes. That's a significant practical consequence that people sometimes forget. It directly impacts their individual tax liability.
Okay, that's how it's treated for the partner receiving it. What's the second purpose, where it's treated as paid to a non-partner? This must be for the partnership.
Correct. The second purpose relates to the partnership making the payment, specifically for determining deductibility under Section 162A, trade or business expenses. If the guaranteed payment meets the usual criteria for being an ordinary and necessary trade or business expense.
Like paying for management services or paying for the use of capital.
Right. Then the partnership can generally deduct these payments. This is just like how it would deduct payments made to an outside vendor for services or interest paid to a lender.
And that deduction reduces the partnership's overall taxable income.
Yes. Which, in turn, reduces the amount of income allocated out as distributive shares to all the partners, including the partner who actually received the guaranteed payment. So it generally lowers the taxable income flowing through to everyone.
But you mentioned a caveat earlier, something about capitalization.
Yes, the crucial caveat. The code says this treatment is subject to Section 263.
Section 263. That's the rule about capital expenditures, right?
Yeah.
Things you can't deduct immediately.
Exactly. This means that if the guaranteed payment is for something that should be capitalized under normal tax principles, regardless of who it's paid to, then the partnership cannot immediately deduct it as an expense, even though it's a guaranteed payment to a partner.
Like what kind of things?
Like maybe a payment for legal fees to help organize the partnership itself, organizational costs, or, a big one, guaranteed payments to a partner for services that create or significantly enhance a long-term asset for the partnership, for example. If a partner oversees the construction of a new building, the partnership will own and use.
So even if it's a fixed payment, determined without regard to income, if the reason for the payment is capital in nature, the partnership can't deduct it right away.
Correct. Instead of deducting it, the partnership must capitalize the expenditure. That capitalized cost might then be amortized, like organizational costs, or added to the basis of the created asset, like the building, and depreciated over time.
So the deduction gets spread out over many years, maybe even decades, instead of being taken all in year one.
Precisely. It's a huge difference in the timing of the tax benefit for the partnership.
So let's go back to Alex, our managing partner, getting the $150,000 fixed salary, if that's purely for his ongoing year-to-year management services.
Then it's ordinary income to Alex, subject to SE tax, and likely a deductible Section 162 expense for the partnership, reducing income before calculating Ben and Chloe's shares.
But if that $150,000 was paid to Alex in year one, specifically for his work in setting up the partnership and getting its initial clients, or for supervising the build-out of their new office space,
then it would likely be a capital expenditure under Section 263. The partnership couldn't deduct the $150K immediately. It would have to capitalize it, maybe amortize the part related to organization over 15 years, and add the part related to the build-out to the basis of the leasehold improvements or building, depreciating it over a much longer period.
which means the partnership's taxable income wouldn't be reduced by that $150K right away.
Correct. And consequently, the distributive shares allocated to Ben and Chloe, and even Alex's own distributive share, if any, would be higher in that year, leading to higher current taxes for everyone compared to if it had been immediately deductible.
Exactly. The impact on the calculation of both the partner's income and the partnership's deductible expenses is direct and significant. This rule ensures that guaranteed payments, despite going to a partner, are still subject to the same fundamental income recognition and expense capitalization rules that apply to deals with outsiders. It stops partnerships from, say, inappropriately deducting costs that should be capitalized just because they paid a partner. And it ensures partners recognize income properly on what are essentially fees for service or capital use.
So while the partner gets a guaranteed payment, the tax treatment for both sides is far from simple. It acts as this crucial bridge between treating partners as owners and treating them as outsiders, depending on the context.
Well put. It really highlights the need to look carefully at the purpose of the payment, not just the fact that it's fixed. Hashtag tag outro. So wow, we have navigated the complex, sometimes choppy waters of Section 707. We've seen how transactions between partners and partnerships aren't always what they seem on the surface.
Absolutely not.
We started with the general rules in 707A, treating partners as outsiders when they act in a non-partner capacity. Then we dove into the disguised transaction rules, 707A2, unmasking payments for services and property sales that try to hide as contributions and distributions, triggering immediate gain recognition and affecting basis calculations.
Crucial stuff.
Then we hit Section 707B, the strict rules for controlled partnerships, disallowing losses on sales between related parties, and recharacterizing gains as ordinary income if the property isn't capital in the buyer's hands. Again, profoundly impacting how gains and losses are realized and actually recognized for tax.
Right, and the constructive ownership rules there are key.
Absolutely. And finally, we explored the unique nature of guaranteed payments under 707C, fixed payments treated as income to the partner and potentially deductible by the partnership, but only if they aren't capital expenditures in disguise.
Yeah, if we connect this all back to the bigger picture,
Right.
I think the core insight from this deep dive is that the IRS, through Section 707, meticulously examines partnership dealings. They are always trying to ensure proper tax treatment by often recharacterizing transactions to reflect their true economic substance.
Substance over form.
That's the mantra. It's paramount for preventing tax manipulation and making sure tax liabilities line up with economic reality, not just clever labels or structuring. Understanding these nuances, disguised sales, control rules, guaranteed payment capitalization, it's absolutely vital for compliance and for effective tax planning.
Because it directly impacts how you calculate your income, your deductions, the character of your gains or losses.
Exactly. And it's definitely an area where getting professional guidance can literally save you thousands, maybe much more, just by avoiding these pitfalls or structuring things correctly up front.
This whole discussion really highlights that careful balancing act the tax code tries to achieve, doesn't it?
Yeah.
Trying to encourage legitimate business structures like partnerships, which offer flexibility, while simultaneously preventing the opportunities for manipulation that flexibility might create. So what does this all mean for you, our listener? Well, next time you're thinking about a transaction involving a partnership, whether you're a partner, or dealing with one pause, and think about these subtle lines Section 707 draws. How might a seemingly simple transfer of property or a payment for services trigger unforeseen tax consequences? Could it be a recharacterized sale leading to immediate gain? A disallowed loss because of control? Or maybe, if structured correctly, could it be a deductible guaranteed payment?
It forces you to look deeper.
It really does. The tax code isn't just a set of arbitrary rules. It's about understanding the underlying intent, trying to ensure fair and accurate reporting based on economic reality. And maybe the biggest takeaway is remembering that the IRS is always looking beyond the surface, always asking that fundamental question, what's the real deal here?